Welcome everyone. My name is Tomo from the Tomo Finance YouTube channel. Thanks for tuning in for a live stream. I'm mixing things up a little bit, and in between videos that I produce, I'm going to try a few live streams where I maybe talk about the finance topic of the week or something like that. So we're going to be talking about ETFs and if holding a core ETF, like for example the S&P 500, and then a secondary ETF, for example perhaps a tech ETF. If there's some overlap in the stocks held in those, is that a bad thing? Do you lose diversification? Are you just mimicking the gains? That's what we're going to be talking about tonight. So to say, check the disclaimer in the information section. I'm not a financial advisor. This information is just general information for education, entertainment, that sort of thing. So having said that, let's get into the topic of tonight, ETFs. So ETFs are exchange traded funds, obviously. One of the most popular ETFs, one of the biggest ETFs is called the S&P 500, which is the top 500 US stocks or top 500 US companies held in this ETF. And so the question that was raised to me is when you hold an ETF like that, and I call that like a core ETF, an ETF that tracks the broader market. So this tracks, majority of the US market. And then perhaps you hold like a secondary ETF, a tech ETF, for example. Is that a bad thing? Are you duplicating the gains? Is there some overlap, that sort of thing? So do you lose a bit of diversification? And I think diversification kind of, what the pros think about diversification. The great Warren Buffett got his poster up on my wall. So Warren Buffett's famous for saying that, diversification for people that don't know what they're doing, which is fair enough. So he's one of the greatest investors of our time. Him and Charlie Munger worked together for many years, and they were very famous for being very concentrated in their holdings, understanding the businesses they own, only owning a few stocks, and becoming very wealthy from that. Having said that, this was their full-time job. They had all day to read companies and receive ideas and things like that. So for people that are perhaps are investing or early on in that investing journey, or do it as a bit of on the side as part of the normal job, diversification can mitigate some of your risks, can reduce some of your risks, and kind of do exactly what Warren Buffett mentioned, that for those unexperienced investors, it can remove and reduce some of your risks. So it won't always be such a bad thing in terms of ETFs. Actually, Warren Buffett recommends ETFs, but that's another story. So one thing that's important to know about ETFs is that they get re-weighed every so often. So as stocks and as companies become bigger, for example, as Apple becomes a bigger company, it has a higher market capitalization, it will become a larger portion of the S&P 500 ETF. And that goes for a lot of the tech stocks. It will have a higher percentage weighing in that ETF than a much smaller company would. So it's trying to reflect and represent the S&P 500, the top 500 companies. So every so often, as companies get bigger and smaller, the ETF gets re-weighed, meaning that companies get sold off in the ETF, companies get purchased in the ETF. So that's that re-weighing process. So that's important to know. Now, the problem with the S&P 500 at the moment, if I share a screen with you, is that this one, I hope you can see that, is that the tech stocks, Apple, Nvidia, Microsoft, Amazon, Meta, Facebook, Alphabet, Google, have become so massive, so big, that they now make up 30%, 31% of the S&P 500 ETF. They make up 1/3 of it. That's massive. It's enormous. Okay. So I guess it's a valid question now. And if these companies make up such a big portion of this ETF, their returns for those companies, their ups, their downs, will ultimately drive the returns of the S&P 500 ETF, being such a large portion of it. Okay, and then the question is, does that, do you even need it? Do you need to hold a tech ETF, for example, because these companies will be in that tech ETF as well? Are you getting a bit of duplication in holding both of those two? But what I would say is that the S&P 500 ETF, as I said, changes over time. So if you think 40 years ago, longer, back in the 80s, the biggest companies in the ETF were not tech companies. The biggest one was, this is a chart here on the screen from 1989. The biggest company was ExxonMobil. Okay. And I'm seeing some other names in there: Coca-Cola, Walmart, PepsiCo, IBM is there, granted, but there are hardly any tech stocks in there. So the S&P 500 changes over time and gets reweighed over time. Back in 1989, I'm sure no one thought that social media companies would become such a large part of the ETF as what they are now. And so why I raise this point is because in the next 40 years, it could be a completely different group of companies that make up that core component of the S&P 500 ETF. It could be robotics companies or artificial intelligence companies or companies we haven't even heard of yet. Okay. So it's constantly changing. It's constantly replicating the market at any given point in time. So because of that, for me, I don't think it's such a big deal holding ETFs that have a slight crossover. You're always going to have a bit of a slight crossover, especially when you hold a core ETF that follows a market. The S&P 500 is one of those. Okay, it's a core ETF. And then any other secondary to ETF in like that tech space or anything like that, you're going to have some crossover. So for me, it's not the biggest deal holding both of them. And I guess a second point for that is, although the tech companies represent 31% of the ETF, you still get you still hold and you still get exposure to the remaining 70% of the companies in there. So you're still getting more than just those tech stocks. And we can see on this sheet, tech stocks there, 32%, right? But you're still getting exposure to all these other areas just by holding that ETF. So you are getting a little bit of diversification. It's not just tech exposure that you're getting. You're getting exposure to a wide variety of areas. So for me, it's not the biggest deal if you hold two and there's a little bit of crossover. I think that's okay. What I think is key and what I think is perhaps the most important thing to focus on, what is the exposure that you're after? So it can be a good strategy sometimes to hold a core ETF, like an S&P 500, ASX 200, that sort of things, and then have a think about what industries or what industries you think are going to take off over the next 10 years, and how do you get exposure to those industries. In doing that, you're going to probably have a little bit of crossover because those up-and-coming industries might already be in that top 500, but you're always going to have a little bit of crossover. So I think it's much more important to think about what exposure you're after, and looking ahead to the future to see, what are the holdings that you want to have. So hope that was helpful. Hope that kind of maybe clarified things in terms of, crossover and holdings between multiple ETFs. Okay, it's not the biggest deal, but that is something to keep an eye on. Absolutely. If you enjoyed the video, you got any questions, please leave me a comment below. Help me with the YouTube algorithm. If you like this video, punch that like button. It helps push it out to other viewers. And if you want to see more from me, head over to my channel and consider subscribing. I do a whole bunch of videos in the finance space. As I said, these are educational videos, really aimed to help you learn. So if you enjoyed it, I hope you got something out of it. I'm trying to have some fun with it. Pretty new to YouTube, so going on a journey myself. But thanks again for tuning in. Thanks again for watching the video. Hope you have a great evening. Take care.